We just closed a condo 5% down, Fannie Mae conventional loan, and the building's reserve budget was less than 10%, which is the key number that every lender in the country looks for. And really, as a realtor, that's always the key thing is how much do they budget? And we got it done. And we're going to talk about how we got it done because the mechanics behind this and how it worked are the same mechanics I explained how condo inventory is not moving. We've got 13 months of condo inventory in Miami-Dade County. I think single family homes are about 6 or 7 months. And there are specific reasons why those condos are not moving in that space. Once you understand it, you're going to see where the real opportunities are. Welcome back to the South Florida Mortgage Report. It's Billy May, your hat dude and wearing mortgage guy, always joined with Craig Garcia, president of Capital Partners Mortgage. We are a South Florida-based mortgage lender. We've got over 50 years combined experience between the both of us. We lend all over the state of Florida, and we talk about everything residential lending. So welcome back. We got a great topic today, right, Craig? Condos and reserves, and that's the key thing. It's one of those words that our referral partners, they think they might know about it, and even a lot of lenders might think they know about it. But really, because every condo questionnaire talks about it, but I don't think most agents or buyers, even some loan officers, really understand kind of the mechanics behind reserves and so forth. And we're going to deep dive that to this morning, right?
Yeah, no. So it's helpful to kind of just take a scale back because you hear the term all the time, and then you go, what is it? What is it really for? Well, think about it when somebody buys a single family house. So you buy your home, and when you buy your home, eventually you're going to have to fix some stuff, right? You buy a house, it's got a 10-year-old roof. You're thinking, okay, I'm going to have to replace the roof at some point. But so imagine you said, okay, the day you buy the property, you go and you say, okay, I'm going to have to replace this roof in 17 years, and it's going to cost me $30,000. And if I do the math, that means I need to save about $150 today a month so I can replace that roof in 17 years. Nobody really does that
No,
as a home.
nobody does.
Right. Nobody does that. But that's what we're talking about doing when you're talking about reserves. Because when you got a condo, you don't have one unit owner, and nobody
Right.
owns the roof. 200 property owners own the roof together. And so because you've got so many people doing that, it's different on a single family home. Yeah, I could go out and get a loan when it time comes to get a roof. I can just pull it out of savings. Yeah. But you got to have a little bit more planning when you have hundreds of people potentially doing something together. And so the reserves is, okay, we're going to start putting away now every month in what we collect so that by the time the roof needs to get replaced, we already have the money. So that's what they mean by reserves. And when you hear about these things, which we'll talk a little later, reserve studies, they're looking at all the big components of that project. And they're tallying up what's needed for all that. And they're saying, okay, so in order to replace the plumbing, which we know we're going to have to do at some point, or renovate the elevators or the fire, there's all these structural components, concrete restoration, and you're budgeting for all of that stuff starting today. So the good news is when you're doing that, now you're not going to have to come up with a big amount of money at some point in the future when one of these big repairs has to get done because you've been paying in all along. But it's not typically how most people would handle their own home.
No. And like you said, to your point, on a single family home, people put some funds aside. They can get a HELOC. They might do a cash out refinance later on to kind of pay for that stuff in a condominium. Like you said, there might be 200, 300, 400 unit owners. And the way the condominiums work is they have boards and people volunteer to be on the board, and the board kind of helps oversee what's going on with the property manager. And the people who live in condominiums, they have an opportunity to vote on these budgets and go to these meetings. Most of them do not. And they don't understand that, hey, there's all these costs, like you said, these costs that you're going to have to replace this in 10 years or 20 years, whatever. So you got to quote unquote budget for that.
Yeah. So historically, the way, and we'll talk about how the condos handle this and then how the lending community handles it. So condos, there were a lot of condos over the years that their philosophy was, doesn't make it wrong. It's like kind of like you're the individual homeowner, like we just talked about. Their philosophy was, let's keep the maintenance fees low as possible as we go along. And when we need something, we're going to do a special assessment. Everybody's going to be aware, hey, we're keeping the maintenance fees low, but it's time that we need a new roof. It's time to repave the parking lot. and everybody's going to get a bill for that repair. It's a one-time thing, and maybe they'll let them spread it out and pay it over time, but that's how they fund it. And occasionally, maybe they would go out and they'd get a loan. So
Yeah.
the association can go to a bank and get a loan that the association pays back to fund some of those things. And and so that's and there were historically condos that were good and you could say well run. And they just would never put the reserves away. They would always do it as a special assessment. And it was really not a lot of ramifications, except for potentially when it comes to the lending side. On the
Yeah.
lending side, the mortgage companies, Fannie Mae, Freddie Mac, they don't want to get involved historically in understanding what do these condos need to be putting away for each of these components. It's too complex for them to look at and analyze
Sure.
historically. And they would say, okay, so we're going to come up with a number and it's 10% of the budget. So if a condo's putting away 10% of the everything that they're collecting, if 10% is going into that piggy bank for the future repair of all these items, fine. Now that's that from that standpoint, we'll allow full financing. So that's what's called a full approval. And you could get if you were a first-time buyer buying in a condo and it was fully approved, you can do 3% down.
Yeah.
And if it was your second home, not a second home, but in other words, you were buying again, and you were not
Right.
a first-time buyer, you could do 5% down. And so the full range of options that you could borrow to buy the property or refinance the property were available on that condo, just like it would be if it was a single-family house.
Right.
Um, and if they weren't meeting this 10%, then you were limited. And that's a limited review. And that would mean in Florida, in most of the nation, it's like 90% instead of this 97, 95. But in Florida, it was 75%.
Yeah.
So you really got ratcheted down on how much you could borrow against that property to buy it or refinance it. So
Yeah.
that's kind
Well,
of the backstory.
condos in Florida. And plus, there was the condo boom in the 70s because the developers came down here, and then you have the retirees. They're on fixed income, and it's hence one of the reasons why they wanted to keep all those monthly maintenance fees low.
Yeah. So and then what unfortunately the horrific tragedy that happened in 2021, the Champlain Towers in South Florida
Yeah.
collapsed, and it brought to light this phenomenon where you have, and a lot of people passed away. It was a terrible situation,
Yeah.
and it brought to light the idea that you could have condos that were really kicking the can down the road to an extreme that it actually caused safety issues. And so that condo, it turns out, had a reserve budget, so they weren't collecting nothing. They had almost, $750,000 in reserves, but they had been staring at a bill to replace all this stuff that they needed to repair of like $16 million.
Yeah.
So they were severely underfunded. They'd had it for 3 years. Apparently, they hadn't done anything about it, and it led to the worst possible situation.
Yeah.
And then obviously the lending communities, Fannie and Freddie said, hey, oh my gosh, this, and obviously for them, the loss of life is above everything else. But from a business standpoint, now they have all these, whatever exposure they had in there. It was terrible for them as from a business standpoint. So they have to
Yeah.
put things in place from a business standpoint and from a human standpoint to say, hey,
Yeah.
listen, if people are not going to abide by things that would cause these buildings that we're lending in to be safe, we're not going to lend there. And so then
Right.
they came back with all this structural component to doing a condominium review that we really never had to deal with before. And
Yeah, the
so,
state of Florida really kind of jumped in there, and initially, like we're going to go into deeper in that is that what they proposed and what they passed, the condo community was like, wait a minute, we can't do all this type of repairs and structure this quickly. So it's been interesting what's happened the past few years since then.
yeah, so the state of Florida came in and they enacted a couple of laws. So in 2022 they did SB4D, and then SB154 in 23. And then the things that are important that came out of that, milestone structural inspections. So every condo 3 stories or higher, 25 years or older that are near the coast, or 30 years otherwise, has to get a structural inspection on a mandated schedule. No exceptions, no waiver. You find out what's going on. And then you got to do a structural integrity reserve study, a SIRS report.
Yeah.
So every building that qualifies for that has to conduct a SIRS report, and it's a formal analysis of every major structural component, how much remaining useful life it has, and what it will cost to repair or replace. And that's the document that says, hey, this is what you should be collecting if you're budgeting for all these things now. Um, and then and then they said, hey, no more reserve waivers. And so they eliminated the ability of condos to vote away reserve funding for structural components effective 24. And so technically, for the previous 30, like I said, the condos would never do reserves. They would just waive it and do special assessments.
Right.
Now, there's some language in the law that says that they shouldn't be doing that anymore. Enforcement, I think, is a different issue because we're certainly not seeing everybody putting away reserves. We're still
Yeah.
seeing some condos that are not doing that. Um, and then Fannie and Freddie, the lending community, came out and said, now we have a whole new 2 pages of a questionnaire that used to be
Right.
5 pages, and now it's 7 pages, 8 pages, and it's asking about these things. And they're saying, hey, if you've got structural inspections that were done in the last 3 years, we need to look at it. And so all that's has become more important. And then condos, if they have um, any of these big repair items that are in process, sometimes that becomes difficult to lend there under
Yes.
Fannie and Freddie, and you need to look at some alternative options. So it's been harder for people to get loans in some of these condos. These condos have had to have put more money away in reserves than they were used to doing, and they've been
Yeah.
kind of mandated to do it. And then also the bad timing in terms of um, skyrocketing increases in the cost of insurance, and
Yeah.
which is a big
Yeah.
deal. So those things have all combined to where people have seen a rapidly escalating situation on their condominium association fees. And that's put pressure on that condo market. So, to your point earlier, the way you led off, we've got 13 months of condominium supply in Miami-Dade County. There's
Mhm.
only 6, 7 months of single family supply. It's more balanced.
Yeah.
And so that's kind of the reasons why. And frankly, it's not getting any easier, probably in the short term here.
Oh,
Um,
no. No, no, no. Not at all. I mean, we're
yeah,
seeing more condos and to your point, to go back to that, like those reports, because when we get that kind of questionnaire, if it says, "Hey, we've had an inspection in the past 3 years," then as a lender, we wanna see it. And those
right.
reports, they get when we read those and it talks about concrete sprawling and concrete restoration and the wording of it, it really can auto lenders just get scared. "Hey, I don't wanna lend in here." When lenders stop lending in there, that's what helps this increase in inventory. The stuff sits in the market because it really, I mean, it's done a lot of good. It's definitely done a lot of good for the condos because it's forcing them to make these repairs, do these things, but it's definitely contributed to the amount of inventory, number one. And number two, there's a lot of new construction in Miami-Dade too. There's a lot of new condos there.
Sure. Sure. So we look at budgets here every day. I mean, every day I'm reviewing a budget on a condominium. And the good news is there are a lot of condominiums that are budgeting a lot of reserves right now. I mean, we saw one the other day and it's like 40%. So that condominium voted to really get on track with their reserves. And so even though you've got some of these rapidly escalating things, and it's certainly putting pressure on homeowners that own these condos that are now having to fund, it is that's the certainly difficult for some people for sure. The good side of the coin is these associations are in much better financial situation than they were prior to doing this. They're going to
Oh,
be
yeah.
in a much better position moving forward to manage getting these repairs done on a schedule that's going to keep things good and safe and optimal for the value of that property moving forward. That would be
Sure.
my opinion.
Yeah.
Um, and I think when I said things are not going to get any easier, well, there's two things, right? So in August, because Fannie and Freddie really said when they look at the condos that they've been having the most problems with, they're the condos that haven't been putting the reserves away. And so they decided to eliminate. They're basically saying, hey, if you're not putting the reserves away, they're really eliminating the limited review process.
Right.
And so, and the biggest thing that would usually cause you to have to go to a limited review would be that the condo didn't put enough away in reserves.
Right.
So now, if you don't have 10% reserves come August, then Fannie Mae won't lend there at all,
Right.
right?
We can't do any. It doesn't matter. Putting 50%
Even
down.
if
We
you put
can't do
50% down,
right.
you can, then
We can
Fannie
do
Mae,
non-QM, but
we got
different.
plenty of options
Yeah.
that are slightly different, and some are
Right.
fairly well priced, right?
Yeah.
But it's different than getting a Fannie Mae loan that you can get
Yeah.
anywhere. And then the other piece is that in January now, that reserve, now they're just taking that reserves and they're saying, hey, we don't want you to see that you're doing just 10% anymore. You're doing
Right.
15% is what they want to see. So, so that is, that's where things in the shorter term for some condos, it's going to get harder. And then
Oh yeah.
there's going to be condos that it's not a problem for because they're already putting away well over 10% reserves, and we've seen it.
So Craig, so tell me now, and this is where I guess it gets interesting. Tell me, how did we close a condo with only 5% down that had this issue with the 10%, the reserves, et cetera, et cetera?
Yeah, which is a great story, and it was eye opening for us too. And I think we've set the stage before getting into this in just a second that there's definitely a conservative nature to anybody lending on condos, generally speaking, when you're talking about trying to go with Fannie or Freddie, because they're concerned, and you can see by what's happening, it's just they're making it a little bit more challenging. They're shrinking the box of where they want to lend.
Right.
So, but this was an opportunity where we got this condo. The condo was not putting away 10% reserves. We thought if this is not going to work out to get a small down payment loan on this property, they were going to have
Right.
to be doing 25% down, and the buyer does not have that to do. Right? There's just not an option for this particular buyer. So we were able to dig in some more. And this is where this opportunity is. And I think you're going to see it more as we're going into the future here is so that 10% and that 15% come January is just so they're putting a number in the sand. Hey, if you meet this, you can get done. But if you're doing less, so you're only collecting 7%, but that 7% represents the fully funded reserves plan based off
Right.
of a third party reserve study. So we go back to that reserve study that we were talking about, that SERS report, where it breaks down all the components.
So the key here from a lending perspective, if we see something and they're not budgeting 10%, our next question's got to be, hey, Mr. or Mrs. the Homeowners Association, do you have this reserve study, correct?
If you have a reserve study
Yeah.
and the condo is fully funding their reserve plan.
Right.
So what happens is, like I said, they get that report. It says, hey, you need to save this much for the roof by this date. You have to save this much for the fire system by this date, et cetera, et cetera, et cetera. So this means, and then on these SERS reports, it'll tell you, today in reserves, you should have X amount of money. And you should be collecting X amount per year in order to be on track to be able to fund all these structural components by the time they come due. And this condo, they're doing just that. They already have what their SERS report says that they were supposed to have in the bank. So they're there. So a lot of times we see these, and they've started this plan, and they've even started to try to get back on plan aggressively, but they're behind today. That's pretty
Yeah.
common.
Yeah.
This condo had enough in the bank to show that they were already saved enough to be on track for this plan, and they were collecting enough in the budget, in spite of the fact that it wasn't 10% of the budget. They have a plan from a third-party entity, and they can show that they showed that they had enough money today, and that they're collecting enough in the budget to be ready when all that stuff comes due, and that's
Yeah.
okay.
Yeah. See, I think that's the key right there because I think most realtors, even most lenders, would have just looked at the budget and said, no, they don't have 10%. They didn't dig in deeper. So, I mean, I really like how many lenders had turned down this condo before we stepped in and did a deeper dive of the analysis and said, yeah, we can do it.
Yeah, and I would say that, and not even every investor. So, as a mortgage banking operation, we have opportunity to work with different investors, and some of our investors are much more comfortable on on how and confident in how they lend on condos than others. Just some lenders are more conservative, and so The idea that a lender is going to be not every lender, even though what I just described makes sense and can be done, and be sold to Fannie or Freddie. I would say that the condo department and every investor that's out there, they're not exactly made equal, and so
Right.
that's not something that you can get done on maybe any loan program with any investor. But I think the more experienced condo underwriting departments at some of our investors, they're okay with that, and so that was able to pave the way to get that transaction done. When I would feel pretty confident saying that not every lender out there and every bank would be comfortable doing that deal.
Yeah, we do find oftentimes we'll get called because we're kind of being known now as a lender that does different condos in South Florida. And I had a call this past week. A gentleman called me up. My big bank, big financial institution, right off the bat said no.
Yeah.
And then we would look at it, like you said, we have investors. When we say investors, we have basically different opportunities to sell our loan, so to speak. And we have some ones that'll buy that will do this condo, or some that won't. And that's why we have multiple options. But to get back to this particular deal where they want, so the agents involved, did they understand from the get-go kind of why their this condominium was kind of more unique from other ones, or why some lenders said no, but we said yes? I mean, did they understand the process behind it?
And I wasn't involved in some of those conversations, so I don't know that I can speak to that exactly. But
Sure.
I think most of the agents that we talk to these days are pretty cognizant of, hey, okay, no, it doesn't have enough reserves. That's pretty there. And the idea that we were able to get it done even though they had less, that's good. Some agents, they still are under this mindset. Oh, if they have a lot of money in the bank, that means they have enough reserves.
Oh, I've heard that a lot. Most
And
agents think, oh, they got tons of money in the bank. I'm like, that's not what we're looking at here.
Yeah, I mean, think about if you had just said, "Hey, I've got a condo and it's got $750,000 of reserves." Sounds like a lot of reserves,
Right. Now
but
we need 16
in
million.
that was in that horrible example, they
Right.
had a $16 million bill that they had to figure out how
Right.
to fund. So it was not a sufficient amount to be ready for everything. So that's why it's funny, Bill. I mean, if you look back over the years that we've been doing this, if you had said back to me in 2019 that a couple years from now, Craig, you're going to be combing through budgets with a fine tooth comb and inspection reports on whole condominium projects to find out
Yeah.
where they are and what projects have been done and what haven't. And the level of detail, I would not have believed you. And
Yeah.
so but that's the state of that of the lending environment on condos today. And so
Yeah.
we
And
just
it's needed.
embraced it. There's no
I mean,
option. And
at the end of the day, it's needed. We've talked about how many times here. There's no more buildable really land in South Florida. Condominium this is it. You want to live in South Florida. Most first home buyers, that's what you got to go. And so they're trying the state of Florida proactively 4 years ago. Said, hey, we need to protect our condo market here. We need to make sure that these condominiums are putting the money away.
So think about this. So that condo that I was just describing that we did with the 5% down, they're in an interesting spot now and this is where, we've had this escalating challenge for a lot of condos where
Yeah.
they're being forced to save more money. Their insurance costs have been going up. And so that problem has not been getting any better.
Yeah.
But a condo that reaches this point where they get to the point where now, hey, you've got all this plan of all this stuff that you have to do and you have to save for it. Maybe you weren't used to doing it. Well, this condo's there. They're saving everything that they need to save for everything that
Yeah.
they know about. Like anything can
Yeah.
happen in the future, just like for anybody. Um, but they're on track. And they actually might be in a position if the insurance costs, which we've been hearing good news about insurance lately. So
Yes.
for a few years, we were hearing horrible nightmare stories from everybody about how much their insurance premiums were going up. Now we're hearing about insurance premiums are coming down.
That's right.
That probably due to some of the laws that have been enacted in Florida to prevent some of the lawsuit situation, which is opening more insurers to want to come back into the market, and then the reinsurance market has gotten better, and so insurance rates are coming down. People are saving money on insurance. So that condo, and that's a condo that you can get into in Dade County for under $250,000, which is not that rare, and
No.
they might be in a position where that association fee might be getting better
Yeah.
in the future,
Actually decreasing.
actually decreasing
Yeah.
because now they're already saving everything that they need to save.
Right.
They've crossed that threshold, and if the insurance starts to become cheaper, that's the silver lining that's going to emerge for some condos once they get over that hump, that
Yeah.
adjustment period. And it's painful for some, for sure. And it's definitely gonna be painful for some unit owners. Maybe they're on a fixed income and they had to deal with all these increases in their association fees. Not easy.
Yeah, that's been a challenge for years. That's kind of one of the reasons why, unfortunately, these condo associations weren't putting away these funds because the residents were mostly on fixed income, and South Florida, unfortunately, is not really a haven for retirees like it was back 40, 50 years ago, or even 30 years ago for that matter. So it's been, like we said, it's been very difficult, but hopefully some relief is coming with the master insurance, like you said.
Correct. And so, yeah, and then I do think the idea that some condos, once they reach this point, they've got that savings plan figured out, and they're on the downside of that. That's gonna be a lot better for their situation, for their property values, for getting financing in there. I think that's all related.
So when we start talking about it, and really on this particular case study, I mean, it sounds to me kind of like if I was to put a big check mark here, that reserve study becomes like really kind of one of the most important pieces on these older condominiums. It's going to really give us the deep dive on what they've been doing and how they plan accordingly or what their intention is to plan moving forward. That reserve study is going to be huge in addition to the budget that we always look for.
Yeah, yeah. So the reserve study certainly becomes more important, and yeah, and I think that there's going to be more condos that are going to try to see, hey, is there a way I can fit into this fully funded? There's going to be certainly more agents and buyers and sellers asking, hey, can we look and see if they qualify for this fully funded category of reserves, especially with the goalpost moving from 10 to 15% next year.
Yeah,
So
yeah.
it
And
should
just
be
as a
interesting to
reminder,
see.
that those new rules start. So right now, up until was it August 3rd, the
Yep,
condominium you have to have 10% reserves, and then starting like you said, next January 1st, they have to have 15% reserves.
correct.
Now, let
Yep.
me ask you, do they have to close by August 3rd, or do they have to make application? What's the
No,
details on
so August 3rd, so they have to have an application in by August 3rd, in order to be able to still do a limited review on condos. So, yeah, so if you've got a listing, and that they don't have 10% reserves, you would really want, and you've got some buyer that comes in that is trying to get a loan with Chase Bank, for example, and
Mhm.
they're putting 25% down. So you think, oh, okay, that should be safe. If they don't make that application with Chase by August 3rd, then there's very likely, I would think Chase may not, and I'm just picking on Chase
Yeah,
as one of
or
the big
whomever,
banks,
right,
that they may not have, because now they're not going to be able to sell it to Fannie and Freddie. They're either going to need to portfolio that, which maybe they would want to. I would kind of suspect they might not want to. And then you're probably going to need to come to somebody like us who's got a bunch of options in the alternative lender space that
right.
are still have an appetite for something like that.
But the mortgage application date has to be before August 3rd, correct?
That's
Yeah.
correct. It's the
Doesn't have
mortgage
to
application
close the
date.
contract,
They
it's
do
gonna
not
be
have to
mortgage
close by then.
application.
Doesn't mean that
Right,
some lenders or banks may not say, you know what, we're just going to institute that now
okay,
because we don't want to mess around. And even though they have the ability to sell it to Fannie and Freddie, uh, uh, banks can choose to, and lenders can decide that they want to have some overlays,
yep,
and not just strictly adhere to Fannie guidelines. So they could say, you know what, I think we'll just implement this early. So that could happen.
gotcha.
Yeah.
So condominiums right now, and you had mentioned, Craig, we're 13 months of supply of condos just in Miami-Dade.
Yep.
Broward number is very high as well. If you are looking to purchase a condo, or if you are an agent, a listing agent, buyer's agent, and you want to deal with condos, it's very complex. Everything we talked about, especially those new rules coming to budget. We are known as a export in condominium financing. And one key thing, we have access to the Fannie Mae approved condo lists. And not every lender will use that list. I mean, we've had plenty of lenders, even if the condominium is on the approved list, they still say no. We have access to that list, and we have access to the list, and it tells us the good condos and the bad condos. So we can help you close more deals, because we're going to dig deeper into the complexity of the condominium, and that list is huge. And like you said, there's a lot of moving parts right now, especially with the upcoming budget requirements, et cetera, et cetera. But especially
Yeah.
if you're listing a condo or if you're buying a condo, contact us. We'd like to help you kind of get through this murky waters.
Yeah, and let me just say that when we talk about good condos and bad condos, so it's really condos that we know we have an easy path through or an easier path through to get a Fannie Mae or a Freddie Mac loan. So if it's on the Fannie Mae list, we have investors that will not require us to get a new questionnaire. We just need to check on the insurance, and we can close in those condos, and we know those condos up front. There's also condos that we know we cannot go to Fannie and Freddie. Does that mean that they're bad necessarily? It's probably not the best word.
Yeah,
Uh,
yes,
but I mean, but it is from a standpoint of thinking and assuming you can just go in there and get a regular loan. It's a
right.
bad assumption. Let's put it that way. So, but those condos, and that could be because, hey, they're a little underinsured in some area. It could be they're in the middle of some huge project and they're not done. Maybe they didn't pass their 40. I mean, there could be a situation you could consider it bad, but it could be something that's temporary. And right now, just can't get a Fannie Freddie loan. What's really helpful to know that before you go make your mortgage application or put an offer in,
Yeah,
that there's certain types of loans you're just not going to be able to get there.
yeah. I
So
mean,
we can help.
if you're a buyer and they go out there, I mean, you pay for an inspection $400, pay for an appraisal $500 to $600, a condo
Yeah,
questionnaire $400 or $500. Before you know it, you put out $1,500, and then 3 weeks later, and you waste all this time. And if you're a listing agent now, you've taken your condo off the market. You learn all these things, and it'll
right.
devalue the property. You're really doing your sellers a disservice if you don't know everything about your condo. If you're a listing agent,
Yeah. And some of those condos, if they're in that temporary situation where they have some challenges, it might be a good deal. I mean, you have to
yes,
kind of do your own diligence about what you think that the value of that property would be once they resolve that issue. But sometimes those condos present opportunities in terms of price point that
yeah.
is tough to find a comparison when you look at single family homes or townhouses.
And there's
So
great deals out there. Like you said, there's
yeah,
13 months of condos in Miami-Dade. There are great,
yeah,
and some of these condos are, you know, financeable. Maybe some
yeah,
lender says no, and we say yes.
yeah. So
Yeah.
anyway, we can help you. It's definitely complicated. It's more complicated than it used to be. But that's why you want to work with people that do it every day. And this is what we do.
Yes.
So.
Absolutely, absolutely. And do we want to close about rates? The rate environment, kind of the ebb and flow, and rates last week, they look a little bit better. This week, looking a little bit better than worse, and it's just kind of crazy. But what's really driving rates, and what's going on in the market right now, Craig?
The reports that we've had as of late are, and everybody can see what's happening, in the Middle East and with oil prices and the gas pump. Inflation report 4.2% year over year.
I know,
Everybody
yeah.
knows that the big driver is with that. So inflation's bad for rates, and the jobs markets. Those reports have been coming out strong,
Yep.
and the jobs market um, is saying, hey, we don't have an employment issue. And so that's usually not good for rates. But rates is not like rates have been freaking out. So that's the good news. So yeah, between inflation and employment, I mean, several months ago, the market was pricing in that we were going to get some Fed cuts by the end of the year. And now there's been more talk about the potential of a rate increase.
Yeah.
And so in spite of that kind of really big mindset change, it's not like interest rates are really escalating through the roof. And then it seems that we've had some potential resolution of the war in Iran that ebbs and flows. And this morning, as we're sitting here talking, it seems like there's some good news in that regard. But that's just doesn't seem to have held.
No,
So we just have to
literally
see.
changing like day to day. It's interesting. And we heard all last year with the new presidential administration is, oh, I want my own Fed chair in there. We're going to cut rates. We're going to do this. And so now the president got what he wanted. He's got his Fed chair in there. And it just goes to show you they're just, it, they don't control what's going on. It's the markets. So what's happening? And like you said, we thought we're going to, oh, maybe cut. Now the Fed could be increasing rates. So very interesting.
But it's just because that that's whatever the market thinks that the Fed's going to do. Remember, we say a lot, rates don't wait. So if they think that, so that's all kind of taken into account. And mortgage rates, we're not going to wait for the Fed to
Right.
cut or increase the rate. They will start moving ahead of time. And so that's why you've seen some gyrations in the rates depending on what's been happening with with the price of oil and all of these things that have been happening. So.
Yeah, so we're still kind of hovering in that 6.5, maybe slightly higher range, maybe
Yep.
lower, depends on the day, number of factors, if you want to pay points, et cetera, et cetera. But that's kind of where we are, and we've been like that for the past few years. So it's kind of this is what it is, so to speak, I guess, right?
We're in range.
We're in the range. So
Yeah.
all right. Good stuff as always. And I'm sure our referral partners will appreciate this deep dive on condo financing. We talk about it a lot, but we do a lot of condos, right?
It's true. It's a huge part of our market down here, and it's certainly the part that is the noisiest. And so, yeah, no, it deserves a lot of talk because the most complex piece that we've got right now. So
Absolutely. All
now,
right.
no, some stats for you. You know how I love my
I
statistics, right?
love the stats, of course. Yeah.
So
I love hearing them.
this week marks 1 year that the South Florida Mortgage Report has been uh, on the
Really?
air. Yes,
Really?
sir. Yes,
Wow.
sir. And
Did
so
you bake a cake or anything? Or
I didn't bake a cake.
yeah.
We didn't throw a party or anything. And it's funny because we have a little group of people that listen to us on a regular basis, and we would love to think that it's growing, and hopefully that's the case. But when you look back over here, it's just funny how we spend some time doing this, and it's been a really good habit for us to be in. So, so we've actually got 53
Yeah.
episodes that we've done over the past year, which I
Really?
thought was interesting. So it's really we did average one a week.
Okay.
Um, 50,000 people have seen something that we have put out, and they've spent hundreds and hundreds of hours listening to us drone on about
That's great stuff.
mortgage and I mean, real estate, and it's just really a really cool thing to think that that amount of time was spent
Right.
listening to us drone on about this stuff.
I think it's great. And I mean, nobody, and I've done research. I mean, I don't think anybody's doing what we're doing. And, we're living the dream here in beautiful South Florida, and we're talking about real time information about residential lending for people, for referral partners, and for prospective home buyers. I've had people tell me
Yeah.
that they watch our report and they learn some things on it. And it's comforting to know that, hey, we're doing a good thing here, we're providing a service, and we're having fun.
Sure, absolutely. So, anyway, yeah, it's always good coming on here and talking shop with you, and hopefully some people get something out of it, and it seems like some people do, and so that's pretty cool. But I thought those statistics were interesting, and the fact that we've been doing it a year.
Yes.
Say most podcasts they don't make it past, I don't know, I mean
I think
20,
10 episodes, I think initially, but maybe it is it 20?
something like that.
Yeah,
That like
yeah, yeah.
90% of them don't make it past. They don't
Yeah.
make it past that far. So
Yeah, and click like, click subscribe, hit the bell so you'll be notified when we have a new podcast. We are on Apple, we are on Spotify as well.
it's true.
And there's a lot of people that I have had people say, "Hey, I listen to the podcast on Apple because I'm driving to work, whatever, whatever." So you don't have to watch us, but you get to hear us.
When we first started doing this, that was my thought was because
Yeah,
I know how I like to consume stuff.
yeah,
I want to go watch a video sometimes when I want to learn how to do something and I want to see how to do it. But when I want to just kind of hear what's going on, I like to listen. And so
yeah.
while I'm doing other stuff. So that was kind of what the genesis of starting this whole thing. But anyway, it's been an
Good,
honor to do
good
this with you
stuff.
for the past year, and
Oh,
I'm excited
my,
about
my honor
continuing
as
to do
well.
it.
We have fun. I look forward to it each week, and we're constantly trying to grow and learn and get more information. So it's all good stuff. So hats off to us, right, Craig?
There you go. There you go. Yes,
All right,
sir.
maybe we'll have a cake next week or something.
Perfect.
All right, sounds good, my friend. Well, you enjoy the rest of your day, and we'll see you
At the closing table.
closing. Right on. Thanks, Greg.
Thanks, bud. Bye.
See ya.